welcome to this chapter on inventories. Inventories are a big, important asset to most businesses. Obviously not to service businesses, but to merchandising and manufacturing businesses they are. We'll start out looking at how we classify inventory, and we'll see that manufacturers have some different categories for different kinds of inventories. We'll look at determining inventory quantities, taking a physical count. Accounting students often think that going out and taking a physical count is pretty easy. Actually, it's a pretty complicated process. It's harder to count things than you would think. Some things, like imagine if you own a forest, then it's difficult to count trees in a forest. We'll also take a look at who owns goods at the end of an accounting period. We have different rules based on whether the items are in transit or not and whether they've been consigned. We'll look at inventory costing. We'll spend most of our time looking at inventory costing methods. And businesses make assumptions about inventory flow. We'll look at different assumptions. Some businesses assume that the first items they buy are the first items they sell. Others make different assumptions about that. And we'll look at the effect of the lower cost or market rule on inventory. We'll explore inventory errors kind of briefly. What you need to know is that if you make an inventory error in 1 year, it also impacts the next year. So inventory errors affect 2 different years. And we'll look at statement presentation and do some little ratio analysis, look at how fast inventory turns over and how many days things are in inventory. Those numbers are helpful in comparing one business to another. For merchandising companies, where you're buying items for resale purposes, they pretty much have one inventory classification, that is merchandise inventory. If you're a manufacturing company, you typically have 3 classifications. Raw materials, that's materials you've bought that you haven't started working with. You have work in progress, and you have finished goods. I think of Boeing Airline as they're making an airplane. They start out and buy raw materials. It might be aluminum, it might be rubber, it might be nuts and bolts. Those are all raw materials. Once they start using them, once they start building the plane, then the plane and the parts going into the plane become a work-in process. Once a plane is finished and it's ready to be sold or ready to be delivered, then it becomes a finished good. Walmart is always interesting. They're so big that anything they do is newsworthy. But in 2004, they started having their suppliers install electronic product codes. So it's kind of like a barcode, only it's electronic and it goes faster. But with electronic product codes, Walmart can actually keep track of individual inventory items. Now, they don't do that with cans of beans, and they don't do that with bananas, but they certainly do it with TVs, music boxes, video games, those kinds of items that are large enough to warrant individual tagging. And I say large enough to warrant. The actual tagging is very cheap. Okay. We take physical inventory for 2 reasons. In a perpetual system, and you'll remember that's where we always keep track of what we have on hand. We need to do it to check the accuracy of the inventory records, and that will help us determine how much inventory was lost, whether we wasted material somehow, it got shoplifted, or employee theft, or it was damaged, or we misplaced it, as is often the case. And if you have a periodic inventory system, that's where we don't know what we have on hand all the time. That accounting determines the inventory in hand, and that tells us how much cost of goods sold is for the period. So taking a physical inventory, as I said earlier, is a trickier business. Most companies like to do it during a slow time. It's ideal if you can actually close the business up. And some businesses will close up for an extra day or 2 just to take a physical inventory. we typically do it at the end of the accounting period, although sometimes we can do it a month in advance, and the auditors are testing the inventory systems as well as the actual counts, and if they're confident that the inventory system is working, then if they do an actual count a month before, they'll still have confidence a month later. Determining ownership of the goods. Goods that are in transit are kind of a special case item. It's purchased goods that we haven't received yet, and if you're a seller, then it's sold goods that haven't been delivered. And we look at the legal title to see legally who's responsible for that inventory. And if you're responsible for the inventory, then it should be on your books. We look at the terms of a sale under the Uniform Commerce Code to determine who is legally responsible for it. And we have a phrase FOB shipping point, and FOB means it's free on board. So if it's free on board shipping point, then after it leaves the shipping point, becomes the inventory of the buyer. So ownership passes to the buyer. If it's free on board to the destination, then the seller has title to inventory until it reaches the buyer's loading dock, at which point the buyer takes control. So we look at FOB shipping point. In that case, the buyer has inventory control, has inventory title. FOB destination, then it would be the seller. Some businesses have consigned goods. Around this area we have a lot of consignment shops. People drop off their old things they couldn't sell at a garage sale or were too expensive to sell at a garage sale. We take to a consignment shop. But a lot of other businesses do that. If you visited some of the nicer artist shops where they sell sculpture and paintings and so on, those are most likely on consignment from the artist. The art shop doesn't go out and buy it. Instead, they let the artist display the merchandise there on consignment, with the understanding that if they sell it, everybody will make some money. But if you don't own the goods, then you can include it in your inventory. So if you're that retail art shop and your goods are all on consignment, you may have no inventory. We look at specific approaches to inventory. The easiest, I say the easiest, if you're Boeing, it's easy to have specific identification of a single airplane. They don't actually lose airplanes. It's a little harder if you're Walmart or Walgreens and you're selling hundreds and thousands of little bitty items to keep track of the items. So there they make some cost flow assumptions. We're going to look at FIFO, which is first in, first out, LIFO, last in, first out, and an average cost method. Too bad we don't have a catchy acronym for that. Specific identification method, actual physical flow costing method, which items still in inventory are specifically costed to arrive at total cost. Their bullet point here is that it's relatively rare. Again, somebody like Boeing probably does it. Maybe if you're making fancy sailboats, you do it. But if you're making cars, you don't do it. If you're making, I'm looking at my mouse pad here, you don't do it. If you're looking at slippers, you don't do it. So we've got an example here of a specific identification thing. We have Crivets TV, and they purchased 3 identical 46-inch TVs. Actually, we know they're not probably identical. They probably have a little different serial number on them. But other than that, they're identical. They bought them on 3 different dates at 3 different costs. They bought one on February 3rd at $700, March 5th at $750, and May 22nd at $800. They didn't sell any until June, and on June 1st they sold 2 TVs for $1,200 a piece. So the question we have on June 1st is which of the two TVs did we sell? Was it the first one and the second one we bought? Was it the first one and the last one? Was it the last two we bought? I mean, we don't know, since presumably they're identical TVs, we wouldn't have any way of telling. So we have to make an assumption. So if Crivet sold the TVs it purchased on the first two in February and the May TV, then its cost of goods sold is $1,500, $700, $800, and it has an ending inventory of $750. So I'm sorry, if it bought the first, if it figures it sold the first and last one, then it works out that way. Cost flow assumption. This does not have to actually be the way the world works. So your actual physical movement of goods might be different than your cost flow assumption. I'd say normally there's some rationale, but not always. Accounting principles here let you make this assumption. So we're going to look at Houston Electronics, and they use a periodic inventory system. And you remember that periodic means that we don't know what we have on hand at any given moment. So they start the month, they start the year, January 1, they have 100 units on hand, and the items cost $10. April 15th, they bought 200 items at $11 a piece. August 24th, they bought 300 at $12 a piece. On November 27th, they bought 400 at $13 a piece. So if we total that up, we have 1,000 items that we need to account for, and our total cost of those items is $12,000. At the end of the year, we went out and determined that we went out and did a physical count and determined that we had 450 units in inventory, and that means that we must have sold 550. Actually, we don't know if we sold 550 or 540 and a few walked off or damaged or whatever, but we need to account for and assume that we sold 550 units. So if we use the first in, first out assumption, it says the earliest goods purchased are the first to be sold, and this often parallels actual physical flow of merchandise, and it's generally good business practice to sell the oldest units first. Sometimes the grocery stores will rotate merchandise that way. You'll find the older items in the front of the shelf and the newer items on the back. So if we look at our numbers when we crunch them this way, down here under step 1, the lower left hand corner, if we have 450 items left, and those were the last items we bought, since the first ones in or the first ones out, the ones that are left must be the last ones we bought. Just let me reiterate that point here. FIFO talks about the goods that have been sold. So if we describe the goods that have been sold, then what's left in the ending inventory is just the opposite. So we need to account for 450 units. On November 27th, we bought 400 units at $13 a piece. So we need another 50 units, so we must have bought those on August 24th. They're part of that bigger purchase of 300 units. We have 50 units there. So we count for 450 units. Our inventory cost is shown in red there at $5,800. If we go over and subtract our $5,800 from our cost of goods available for sale, we wind up with cost of goods sold of $6,200. So in the pale blue, pale green here, that's the items that we sold, while the tan color is the items that we have on hand. We'll take a look at the LIFO method using the same numbers, and then we'll see that there are differences. But it seldom coincides with actual physical flow of goods. Some exceptions are goods included in piles or goods stored in piles such as coal or hay. So you'll remember we have 450 units left, and if the last one's in or first one's out, then what's left must be the first one's in. So we need to again count 450 units. We started the year with 100 units. We show that factor here. April 15th we bought 200 units, and August 24th is remaining to where we get our other 150 units. So we come to a total of 450 units. So we show up there with a total cost, our inventory value of $5,000. We subtract that from our cost of goods available for sale, the $12,000, and we come up with a $7,000 cost of goods sold. So again, the numbers in beige here are the ones that are left, and the ones here in blue or at pale green are the ones that were sold. Then we'll also take a look at average cost, and for a lot of businesses, average cost probably makes more sense. From an accounting student's perspective, it's probably easier to understand because we're not looking. We don't have to make any goofy assumptions. Here we assume that when we sell something, it came equally out of every purchase. So we bought 1,000 units, and it cost $12,000. So we do a division here and say that each item in inventory, simply put, was $12. So if we have 450 units left, and we multiply it by $12, we wind up with $5,400, and that becomes our ending inventory. And we subtract the $5,400 from our $12,000 to get a cost of goods sold of $6,600. So here's a graphic there. It just shows that we're assuming all the units, the ones we sold and the ones we have on hand, they all cost $12 a piece. And here's our comparison of the income effect and income tax expense. You can see that with FIFO, our gross profit is $5,300, and LIFO it's $4,500, while average cost is $4,900. So we have some pretty big differences in cost here, and that your gross profit will of course influence your operating income, which will influence your income taxes. So here with a FIFO we pay $990 income taxes, LIFO we pay $750, and an average cost we pay $870. So that can be those assumptions are important assumptions to make in terms of cash flow because it impacts our tax bill. So a quick review question here of a cost flow method that often parallels the actual physical flow of the merchandise is, that would be the first in, first out method. Another quick review question. In a period of inflation, the cost flow method that results in the lowest income taxes, that's going to be the LIFO method, if you remember from our chart a while back. But assuming that prices are rising all the time, we have constant inflation, then the items that we buy most recently are most expensive, and of course that will result in the lower cost of goods inventory, higher cost of goods sold. We need to use the methods consistently. We can't flip-flop from one year to the other. And if you're going to make a change, you have to have a good compelling reason for doing that. Quaker Oats here, this is a note. At some point Quaker Oats got bought by Pepsi, so I assume this is before that happened. And we have a question of is LIFO fair? And interesting to note here that international accounting standards don't allow the use of LIFO. So that some of our big foreign oil companies, BP and Royal Dutch Shell, makes comparison to U.S. companies a little harder because they use different accounting rules. The lower of cost or market. Some inventory items can dramatically fall in price, particularly items that are fad items that can. Beanie Babies can be worth a lot of money one day and the next day nothing, or to go back a long ways, hula hoops. But computers are subject to that kind of pricing. Almost any electronic gear can just be valuable one day and worthless the next. So when that happens, companies should write down the inventory to its market value in the period in which the price declined. It's an example of being conservative. So the example here, we have flat screen TVs that cost $60,000. Their market value, we go out and replace them for $55,000. So using the lower cost or market, we would extend $55,000 into that column. The next item, satellite radios, would cost us $45,000. It would cost us $52,000 to replace them. So we keep with the cost because it's lower at $45,000. DVD recorders, market's lower there by $3,000, so we bring over $45,000, and DVDs are lower. Inventory errors. Common causes, don't count something right, or we don't price it correctly. And as I said earlier, counting inventory is a lot harder in practice than it is in theory. Second bullet point is not properly recognizing and transfer legal title of goods in transit. Companies can mess this up at year end real easy because you don't worry about it during the year. Only at year end, when you're trying to get a good clean cutoff on your inventory, does it make a difference. And errors affect both the income statement and the balance sheet. So here's an example where if inventory errors affect the computation of cost of goods sold, and obviously cost of goods sold affects or is part of the inventory count, and that affects net income. Down at the bottom here, understate beginning inventory will result in understatement of cost of goods sold and overstatement of net income. And you can see that the relationship between these two is the opposite. So if one's over, the other's under. If one's under, the other's over. So if you can figure out what's going to happen on net income, you'll know the impact on cost of goods sold because it will be just the opposite. Inventory errors affect the computation of cost of goods sold and net income in two periods. Because we have a beginning and ending inventory balance that will in fact impact both years. Over a 2-year period, they're going to offset each other because it'll come out all right. And the ending inventory depends entirely on the accuracy of taking and costing the ending inventory. Here's just a brief example where they made a $3,000 error in this year. It gets corrected in 2011, and it nets out to be the same. In 2010, we understated income by $3,000. In 2011, we overstated it, so it in essence washed out. So understating ending inventory will overstate cost of goods sold, and if we overstate cost of goods sold, that means we understate net income. So balance sheet effect. The inventory errors also affect the basic accounting equation, 11th commandment. So if our ending inventory is overstated, then assets are overstated and liabilities must be overstated. We're going to keep the accounting equation balanced. The ending inventory is understated, assets are understated, stockholders' equity is understated. So presentation of inventory information on the balance sheet. Inventory is classified as a current asset. That assumes that we expect to sell it within a year. If we don't, then it probably becomes some other kind of asset. And on the we have a presentation on the income statement. We have a separate calculation of cost of goods sold, and that gets subtracted from sales. And then footnote or someplace else, they want full disclosure of how we classified our inventory, how we're doing inventory, whether it's cost or lower cost or market, and what assumptions we make about the inventory. Are we assuming that the goods flowed out of the business in a FIFO, LIFO, or an average basis? Inventory, when you're trying to figure out a company and look at its balance sheets for clues, the inventory is, as they said here, a double-edged sword. If you have too much inventory on hand, you have a carrying cost of inventory, it ties up money, you may have to have it stored, you got insurance, you worry about it going obsolete, you worry about damage, you worry about somebody stealing it. The flip side is if you don't have enough inventory, you may not have inventory to sell. You might be out of stock and lose sales and not be able to catch up on lost business. We do commonly do a couple of ratios regarding inventory. First is inventory turnover, and that's going to measure the number of times on average that the inventory is sold during the accounting period. To compute that, you take the cost of goods sold and divide it by the average inventory. And the average inventory is simply take the beginning inventory, add it to the ending inventory, and divide it by 2. And that'll give you an inventory turnover ratio. Then the days in inventory tells you average number of days that you keep something on hand. So we take the days in a year, usually 365, and divide it by the inventory turnover number that we computed earlier. That tells us how many days we keep items in inventory. Example here with Walmart. Its 2008 annual report shows a beginning balance of $33,685 million and an ending inventory of $35,180 million. And cost of goods sold for the year ended January 31st. Notice that they have a fiscal year, not a calendar year end. But income was $286,515 million. So they show the computation there. Inventory turnover turns out to be 8.3 times. Notice how they take cost of goods sold and divide it by the average inventory. And they computed average inventory at 8.3. Then days in inventory turnover of 8.3 divided into 365 is approximately 44 days. So on average, overall for Walmart, they turn their inventory over every 44 days. Obviously some things turn a lot faster than others, but the overall number is 44 days. We've talked about, in fact we had a bunch of examples of using our inventory flow assumptions, LIFO, FIFO, with a with a periodic inventory system. The periodic, we go out at the end of the accounting period, count what we have, and then we do our computation cost of goods sold. With Perpetual, you remember every time we make a sale, we make an entry to sales as well as an entry to cost of goods sales. So if you can still do that with your LIFO and FIFO assumptions, but the calculations are a little more labor intensive if we're doing it every time. But fortunately, almost everything is computerized these days, so the computations aren't really that difficult. So here's some basic numbers again for Houston Electronics. Beginning inventory of 100 units. April 15th we bought 200 units. August 24th we bought 300. September 10th we sold 550. November 27th we bought 400. So if we use a FIFO, first in or first out, and we need to price those that we sold on September 10th. And you remember we sold 550 units on September 10th. So the first ones in is that 100 we started with, then 200 that we bought on April 15th. So that's a total of 300, and we need a total of 550, so the other 250 comes out of the August 24th purchase. So we just price those out, 100 units at $10, 200 at 11, 250 at 12, and that becomes our cost of goods sold. Obviously, in real life you have a lot more transactions, but the theory is all the same, and the computer will do it for you. We have a last in first out method. Again, we sold 550 units on September 10th. The last ones in on September 10th were the 300 that we bought on August 24th. So those will be gone. Next ones in are the 200 at $11 on April 15th, and then 50 from the beginning inventory. So again, we price those out, come up with our cost of goods sold. And ditto, same thing with average cost. We look at the items that we had on hand January 1st, April 15th, August 24th. Figure out the average of those. Then when we sell 550, that becomes our unit price of $11.33. We're changing horses a little bit here. We do a lot of estimating inventory because it's a lot of work to go out and count inventory every month or every quarter. So we have a couple of methods that rely on estimates. One is the gross profit method. And we estimate the cost of ending inventory by taking a gross profit rate, applying it to net sales. Let me give you an example of that. Okay, Washi Company's records for January show net sales of 200,000 at a beginning inventory 40 and a cost of goods purchased of 120. The company expects to earn 30% gross profit rate. So to compute the estimated cost of ending inventory January 31st using gross profit margin. So if net sales were 200,000 and we're going to have gross profit of 30%, 30% of 60 of 200,000 gives us 60,000. So our estimated cost of goods sold must be 140. Then we can plug that in down at the bottom here. Take our beginning inventory of 40 plus our purchases of 120 gives us 160,000 available for sale. We had estimated cost of goods sold of 140, so our ending inventory must be $20,000. Those are pretty good numbers. You know, if you mark things up at a pretty routine rate, they'll generate pretty good estimates. We still need to take inventory at the end of the year and adjust to actual based on that. We also have a retail inventory method. There the company applies the cost to retail percentage to ending inventory at retail prices to determine the inventory at cost. So step one there is goods available for sale at retail minus net sales is the ending inventory at retail. That first step is critical. Goods available for sale at retail, we don't typically record that. When we buy something, we record it at our cost. But they're saying for our purposes here, we're going to also record it at retail, so that what we have inventory available at retail minus net sales would leave us our ending inventory at retail. That will be maybe clearer in the example. Let's try the example. So at cost, we have a beginning inventory that costs $14,000. We're actually going to sell it for $21,500. So we know what we're going to sell it is for $21,500. We purchased goods during the counting period of $61,000. we're going to sell those for $78,500. So total goods available for sale cost us $75,000, and we're going to sell them for $100,000. So if we actually had net sales of $70,000, that means we have $30,000 left in ending inventory at retail, and we need to adjust that to get to our cost number. And they do that by taking the 75,000, dividing it by 100,000 to get a 75% ratio. And then we multiply that times the 30,000 to come up with 22.5. You probably need to play with this in your mind a little bit to it's pretty logical, but you probably need to crank through numbers a few times and make believers out of yourself.